When it comes to growing your real estate investment portfolio, the key isn't solely in choosing the right property type, its price, or its age. Equally important is devising a strategy to maximize your returns from that property. In this video, we'll delve into a variety of robust property investment approaches and elucidate how each one can serve as a means to generate substantial profits. What is an investment property? Let's begin with the fundamentals. To kick things off, it's essential to grasp the core principles of property investment. An investment property encompasses any real estate acquisition made to realize a profit down the road. When you invest in real estate, you're essentially staking your claim on both the property's immediate worth and its potential for long-term growth. In the world of property investment, you'll find seasoned investors managing extensive portfolios, while others achieve success with a more modest number of properties. Investing in real estate offers a brilliant avenue for putting your savings to work effectively, rather than allowing them to stagnate in a bank account. Property investors embark on a purposeful journey, selecting specific properties that align with their portfolio building objectives. The intention might be to renovate and subsequently sell for a profit, or to retain the property as a long-term rental. In contrast, the conventional homeowner typically acquires a residence primarily as a place to live, with any potential selling gains viewed as a pleasant bonus. Regardless of your approach, becoming a property owner inherently classifies you as an investor. Thus, it's imperative to acquire the knowledge and skills necessary to manage your finances adeptly, facilitating your path toward financial independence. If you find this information valuable, remember to hit the subscribe button below. By subscribing, you'll stay updated on upcoming videos that can empower your property investment journey. Don't miss out, subscribe now. Buy and hold. Buy and hold remains an enduring and esteemed method in the realm of property investment. Its appeal transcends the spectrum of investor backgrounds, from newcomers to seasoned developers. Here's how it unfolds. Investors pinpoint properties laden with substantial potential for long-term capital appreciation. These assets are acquired and safeguarded for several years, ultimately reaping a handsome profit upon sale. Consider this compelling statistic. Over the past 2 decades, Australian house prices have showcased an average annual growth rate of approximately 7%. This figure underscores the fact that investments executed within the buy and hold framework can accumulate tens, if not hundreds, of thousands of dollars in capital growth within a relatively brief time frame. This strategy promises formidable long-term returns. In the shorter term, property owners have the option to lease their investments, deploying rental income to defray essential expenses such as mortgage obligations, enhancements, upkeep, and taxes. In the pursuit of buy and hold, it's essential to be vigilant about rental yields. Ensuring that the rental income in a given area effectively offsets your financial outlays takes precedence. In cases where the rental income falls short, it becomes incumbent to possess adequate financial means to bridge the gap. Positive gearing. Positive gearing, also known as a positive cash flow strategy, is all about property investments that deliver substantial short-term income, yielding a profit that sets it apart. This approach is particularly favored by novice investors. The income generated serves as an additional revenue stream, aiding in expedited mortgage repayment and, in turn, bolstering your financial standing. The added income boost has the potential to amplify your borrowing capacity, streamlining the expansion of your real estate portfolio. However, it's crucial to note that positive cash flow properties often present a trade-off. While they may offer somewhat modest capital growth rates ranging from 4% to 6%, they compensate with more robust rental yields, typically exceeding 6%. These attributes make positive gearing an enticing option for beginners, but it does require hands-on involvement in tenant management. It's imperative to recognize that the surplus cash flow will necessitate more frequent tax payments. If you aim to steer clear of negative gearing, it's vital to ensure that the rent you charge can effectively cover all mandatory expenditures, including mortgage commitments, interest, fees, maintenance, and taxes. For those seeking an elevated challenge, there's the prospect of achieving positive income and capital growth by investing in locations poised for long-term demand surges. This advanced investment strategy, however, competes on a high level, given the fierce demand for such properties. Yet, if you manage to secure such real estate, you can relish the twin benefits of rental cash flow to expedite mortgage reduction and the promise of substantial long-term capital gains. Negative gearing. Negative gearing represents a distinctive property investment strategy where the immediate expenditures related to the property surpass the rental income it generates. In essence, this approach leads to a monthly financial deficit on your investment, requiring you to utilize your regular income to bridge the financial gap. At first glance, this might seem like an unfavorable proposition. However, there's a compelling twist. Investors can leverage negative gearing shortfalls as tax deductions to mitigate their overall tax liability. In most instances, this strategy entails the acquisition of properties with substantial potential for capital growth but limited cash flow prospects. You shoulder the short-term losses, ultimately paving the way for significant profits down the line. During this period of investment, you can capitalize on tax deductions for the losses incurred, effectively reducing the financial commitment associated with property maintenance. Nonetheless, it's paramount to acknowledge that this strategy demands an ample income flow to offset the short-term financial losses. Additionally, it is best suited for investors situated in higher income tax brackets, as they possess larger tax liabilities that can be effectively counterbalanced through this approach. Among the various investment strategies, it's crucial to recognize that relying on tax incentives carries a notable level of risk. Renovate and hold. Opting for property renovations offers a compelling avenue to augment your investment's worth and nurture your equity. Nevertheless, the journey of refurbishing a property is no small feat, and it requires the skilled hand of an experienced individual to steer the project towards success. Within the framework of the Renovate and Hold strategy, investors set their sights on properties that possess untapped potential. These properties are then subject to meticulous renovation, a process designed to elevate their market value. Once the renovation endeavors reach fruition, the property can be placed on the rental market at a premium rate, potentially allowing investors to shift into positive gearing territory. Renovate and hold proves to be a highly effective strategy, particularly for seasoned investors. However, it does bear a higher degree of risk when juxtaposed with the acquisition of a new property or an existing property in good condition. It's worth noting that, akin to any renovation project, precisely estimating the project's timeline and budget can be a challenging task, adding a layer of complexity to the execution of this strategy. On the bright side, opting to revamp a property can serve as your gateway to entering sought-after neighborhoods at a more modest price point. With the right expertise, this strategic choice could lead to an investment characterized by substantial capital growth and high rental yields, all acquired for a fraction of the cost associated with newer properties. Renovate and sell. Injecting fresh life into an investment property can significantly elevate its allure to potential renters. This strategic move empowers you to command higher rental rates, a step toward the realm of positive gearing. However, if your objectives lean more towards short-term financial gains rather than a prolonged investment journey, the Renovate and Sell approach holds the promise of immediate profits. The essence of Renovate and Sell revolves around the acquisition of properties in need of refurbishment, followed by meticulous renovation efforts, culminating in their resale for a profitable return within a relatively short span. This investment strategy, while brimming with potential for lucrative returns, is equally fraught with elevated risk levels. The intricacies of estimating costs in renovation projects often pose a formidable challenge. Unforeseen surprises, unanticipated labor demands, price fluctuations, and project delays can all chip away at your anticipated profit margin. Furthermore, this investment style necessitates your active and hands-on involvement, with the onus on you to oversee every facet of the renovation work. On the flip side, a seasoned renovator with a discerning eye can reap substantial profits through strategic property enhancements. The key lies in the ability to identify properties ripe for transformation. Achieving this demands a profound grasp of construction, renovation dynamics, investment principles, and an acute awareness of the local property markets. As such, this strategy is best suited for investors with a wealth of experience under their belts. Building for profit. An increasing number of investors are now gravitating towards building for profit, embracing house and land packages as well as uncomplicated projects. This method of investment streamlines the property acquisition process. With this approach, you acquire a brand new home, specifically designed to pique the interest of potential renters, potentially paving the way for positive gearing. Furthermore, it alleviates concerns related to immediate expenses such as renovation and upkeep. Constructing a new home might sound straightforward, but it does entail a need for sound design insight. The ideal home should seamlessly harmonize with the land, and from a project perspective, the numbers should ideally align in your favor. For instance, a $350,000 investment in land coupled with a $350,000 expenditure on the home should effectively translate into a combined value of $750,000. There's a strategy at play here. By enhancing the land's value through construction, you create an opportunity for profit. Property subdivision. Property subdivision entails the art of identifying a sizable land parcel and partitioning it into several smaller, individual parcels. Each of these smaller parcels can be sold separately, an endeavor that results in an instantaneous surge in your equity. To illustrate, let's say you acquire a substantial land parcel for $700,000 and undertake its subdivision into 2 individual properties, each appraised at $450,000. This strategic move amplifies your equity by a substantial $200,000. However, it's important to note that this strategy is ideally suited for seasoned investors who possess an adept understanding of the intricate landscape of property development. The process of subdividing a property necessitates engagement with local council authorities and meticulous adherence to stringent planning prerequisites. Moreover, it incurs supplementary planning, council, and survey-related expenses. As such, you must possess unwavering confidence that your initial investment outlay will translate into a rewarding profit. It's also noteworthy that discovering suitable properties for subdivision can be a challenging quest. Sizable properties, particularly in coveted inner-city locations, are in high demand, which can potentially erode your anticipated profits. What different types of investment properties should you consider? In the realm of investment properties, diversification knows no bounds, extending far beyond the confines of residential houses. The path you choose depends on a variety of factors, including your initial financial commitment, your desired income timeline, your ownership aspirations, and your willingness to devote time and effort. Indeed, an investment property doesn't exclusively signify a traditional residential home. There's a broad spectrum of property investment alternatives, each potentially well-suited to your specific capital allocation. Some of the more conventional investment property choices encompass standalone houses. Residential standalone houses enjoy consistently high demand, rendering them a gateway to robust returns. Apartments and condos. Investing in apartments can position you to cater to long-term renters, delivering a steady stream of cash flow. Townhouses. These properties offer a balance between indoor and outdoor space, attracting renters seeking a bit more room. Villas. Villas represent larger estates in rural locales, often accompanied by higher purchase prices and the promise of substantial returns if the right location is secured. Entire apartment buildings. While these complexes can be challenging to come by, they hold potential as valuable investments, provided you're prepared to handle the elevated price tag. Student housing apartment buildings. This choice, while viable, tends to offer a narrower profit margin, prompting caution from many investors. Industrial or commercial real estate. The commercial property sector presents an attractive investment avenue, albeit better suited for investors with ample market experience, rather than new entrants. Beyond property type, you also need to contemplate whether you prefer a new or pre-owned investment property, as well as the extent of your financial commitment. These considerations will shape your investment journey and potential returns. Apartments versus houses. Diving into apartment investments offers an enticing gateway, characterized by a more modest initial purchase cost paired with the potential for robust returns. Renters often willingly pay a premium for the location and amenities that apartments typically offer. Moreover, fully established apartment complexes generally bask in a steady trajectory of value appreciation. However, it's worth noting that attracting prospective tenants in less developed areas may pose a challenge. When considering the acquisition of older apartment units, it's crucial to bear in mind that undertaking renovations to enhance their value could be met with hurdles. Building owners and body corporates may impose restrictions on specific modifications, requiring careful navigation. In the realm of property investment, homes with substantial land sizes, particularly standalone houses, have consistently demonstrated a track record of enduring price appreciation. As such, they are often heralded as a sound and enduring long-term investment choice. While the upfront cost of securing a standalone house may surpass that of an apartment, houses tend to exhibit consistent and favorable appreciation trends throughout your property investment journey. New versus old. The choice between purchasing a new property or an older one carries its own set of considerations. Opting for a new property opens the door to selling or renting with minimal, time-efficient renovations. This allure is amplified by the fact that many buyers and renters exhibit a preference for new builds, making it relatively easy to attract interested parties. However, the primary challenge associated with modern properties often pertains to their higher initial purchase price. Nevertheless, it's essential to note that new property buyers can often access various tax benefits that may not be extended to those investing in second-hand properties. Conversely, venturing into the domain of older real estate investments offers the advantage of acquiring properties at significantly lower price points. These properties can be strategically renovated to yield immediate positive cash flow. It's important to underscore that the established property investment strategy requires a substantial commitment of time and effort. Low versus high price. Delving into high-priced properties demands a substantially larger deposit and a more sizable loan commitment. However, the allure of investing in these upper echelons lies in the potential for significant rewards. During economic downturns, properties in these price brackets may encounter challenges in terms of selling or renting, given the prevailing apprehension regarding overspending. Yet, it's essential to recognize that they can simultaneously deliver the most substantial capital growth percentages during upmarket swings. In contrast, the demand for more affordable properties remains resilient, even in the face of economic adversity. Lower-priced options tend to remain a sought-after commodity, as they represent the economical choice. This segment offers financial accessibility in terms of down payment and mortgage repayments, accompanied by lower land tax expenses and reduced overall risks. Consequently, lower-priced properties present a fiercely competitive landscape and tend to be a scarce find. The process of building your property investment portfolio is a multifaceted journey that transcends mere considerations of property type, price, and age. It necessitates a deeper examination of how you intend to harness your property for financial gains. Dealing with rental property managers. When embracing the cash flow rental strategy, you must weigh the complexities of property management into the equation. Even with tenants committed to year-long leases, the responsibilities include overseeing application and screening processes, attending to property upkeep, repairs, and occasionally, the turnover cleaning or maintenance between residents. Any complaint from a tenant regarding a malfunctioning air conditioner, a leaky faucet, or a burnt-out light bulb necessitates swift resolution. The challenge multiplies when you possess multiple properties, leading to a considerable demand for individualized attention. Typically, a seasoned investor will opt for the services of one or more property managers. These professionals specialize in supervising all leasing operations and maintenance tasks. A property manager streamlines the process, enabling efficient rent collection, tenant management, and coordination with maintenance professionals when needed. Property investment pros and cons. In the realm of property investment, each strategy presents its distinct advantages and drawbacks. It's imperative to weigh the following factors. Pros. Positive property market history. Australia's investment properties boast a history of consistent and lucrative outcomes, with a notable upturn in the property market over recent decades. Decent outcome control. Unlike placing your fate in the hands of a corporation, property investment empowers you to exercise full control over your investment decisions, reducing dependence on external entities. Convenient lending. Banks and private lenders exhibit a greater inclination to extend loans for investment properties as compared to stock shares. The reason lies in the ability to liquidate the property to settle the loan, a safety net that stock investments may lack. Tax benefits. In specific cases, property investors can leverage various tax incentives and programs such as negative gearing. Steady appreciation. Unlike businesses, properties tend to maintain their value consistently, offering a dependable avenue for appreciation. Insurance. Property investors can readily obtain insurance packages to safeguard their investments against risks associated with tenants, renovations, and property development. Short and long-term income. Depending on your chosen investment property strategy, you can derive both short-term gains through rental income and long-term wealth upon property resale. Cons. Substantial upfront investment. Property investment typically demands a significantly higher initial investment compared to stock shares. Many investors must allocate a minimum of $10,000 solely for the deposit, and increasing competition necessitates substantial savings or loans. Higher risks with fewer properties. Novice investors frequently commence with a single property rather than diversifying upfront. Placing all stakes in one investment entails higher risk, especially if the investment underperforms. While the property market is generally low risk, certain property types may experience more frequent value fluctuations. Unforeseen expenses. Property ownership entails the acceptance of unforeseen expenses, including repairs, fluctuations in interest rates, renovations, storm damage, and more. An unexpected event such as hail damage can entail significant roofing expenses. Ongoing costs. Property investment is not a one-time transaction. Beyond the initial acquisition, investors must contend with ongoing expenses like insurance, taxes, mortgage payments, renovations, property management, utilities, and more. Renter issues. Rental property owners often confront challenges such as vacancies, missed rent payments, or other scenarios that may disrupt expected income streams. Market and interest rate fluctuations. The property market is influenced by shifts in supply and demand, resulting in market fluctuations. While property values typically rise, specific areas may experience price declines. Opting for investment-grade properties mitigates the risk of purchasing depreciating assets. Unprofitable properties. Non-investment grade properties situated in less than ideal locations may bring about greater expenses and challenges than profits. Inaccessible funds. The sale of property demands more time and effort compared to the quick liquidation of stock shares, limiting access to immediate cash in the event of unforeseen financial needs. Potential government actions. While government regulations pose a minimal risk, it's prudent to acknowledge the potential for rule changes, such as alterations to programs like negative gearing, and avoid over-reliance on such initiatives within your investment strategy. As you wrap up this insightful discussion on property investment strategies, you've gained valuable knowledge to set you on the path to financial success. Investing in real estate is a powerful way to build wealth, and with the right strategies, you can achieve your financial goals. But, as with any journey, there are pitfalls to avoid. If you're keen on navigating the world of real estate with confidence and wish to steer clear of common mistakes, we've got you covered. Simply click on the video shown on your screen to explore the essential guide on real estate mistakes to avoid. It's the next step in your quest for successful property investment. Thank you for joining us today, and we look forward to guiding you through the nuances of the real estate landscape.